Nilesh Shah, MD and CEO at Envision Capital, is now joining us. Nilesh, in terms of budget, that will be the key event to watch out in the first week of Feb. Do you think that market expectations are getting realistic? At least the talks, the sort of chatter that is going around into the market community. Do you think budget expectations are getting unrealistic?
Well, Pankaj, I think that what the market is really this time trying to convey is that this is going to be an all-important budget. We have seen budgets for all these years, and they have been the normal statement of accounts. But I think this time around, the expectations are that this cannot be a routine or an ordinary budget. This has to be an extraordinary budget, a budget which focuses a lot more in bringing growth back. This is a budget which should hopefully unveil a lot of plans and measures and initiatives to kickstart growth which can take the GDP growth well beyond the 6-7% at which we have been cruising along, and see how private investment can kickstart, how public investment can accelerate, how consumption increases significantly, and how finally it results into an increased economic activity and job creation. So I clearly believe that while these have been the expectations for all these years, but clearly this time around, the budget becomes a very, very important platform to unveil a lot of these measures at these multiple objectives.
Right. After demonetization, has expectation drastically increased?
Yes, I think clearly the expectations are that yes, demonetization has been a good measure, a step in the right direction, and that on its own may not be good enough to essentially clean up the entire system or to sanitize the system, and that having done demonetization, it will have to be followed up by a lot of measures to kind of bring growth back, to kind of offer some fiscal incentives to corporate India to basically go ahead and make investments, and to basically offer some tax benefits to individuals and households, which can result into higher disposable income, which will find its way into the consumption basket of the country. So clearly, post demonetization, the expectations have gone up that the demonetization initiative will be followed up by certain benefits, tax incentives, and even on an extreme basis, that the government might even come up with a universal basic income scheme. I think these are essentially the kind of expectations which have cropped up post demonetization.
But do you think they are realistic after demonetization?
Well, it's always a tough line to take in terms of whether expectations are realistic or not. And I think the segment which has the expectations will always believe these expectations to be the bare minimum, and probably on the other hand, maybe policymakers would probably believe that some of these expectations are far-fetched. But if you really look at it, I think reduction of corporate tax rate is something which I think this government had mentioned 2 years or 3 years back, that the stated objective is to take the corporate tax rate down to 25%. I think that's something which was there. Withdrawal of some of these exemptions was always on the cards. So to that extent, some of these expectations have already been kind of stated earlier as well. So I don't think the tax-related exemptions are something which are probably very high on expectations. The other set of expectations are a bit contrary, that on one hand everybody would want the government to adhere to a fiscal discipline program, but this time around I think I see a lot of economists and market participants saying that it might just be all right to kind of deviate a little away from the stated fiscal deficit object if it finally helps in kickstarting the investment cycle, leads to enhanced public investments, if there is a focus on some of the basic sectors like housing, especially affordable and low-cost housing, and if all this can result into higher economic growth. So I think for the first time around, I think what has really been the hallmark for the last 3 years is to prioritize fiscal discipline versus growth. I think this time around, I think somewhere the market or the street should be fine if growth is given a priority versus fiscal deficit.
Right. And as an investor, say if there is a marginal deviation from the targets of fiscal numbers, would you be worried?
No, I don't think one would be too worried about that, because the reality is that some of these measures like demonetization, GST, essentially is going to bridge the gap between the organized and the unorganized. And this will finally result into better revenue collections. This will finally result into better economic growth. So what these measures like demonetization and GST will do would be to basically feed and create a virtuous and a benign economic cycle which will result into significantly higher revenues for the government. So to that extent, I think a temporary aberration or a temporary deviation away from the fiscal deficit target, I think at this stage would honestly be very worthwhile. So I think it would be good if the government goes ahead and pushes up public investment and offers some of the other fiscal benefits and incentives and SOPs so that private investment essentially comes back and kickstarts. And I think over a period of time, this fiscal deficit, this temporary deviation away from the fiscal deficit will get addressed, number one. Number two is, I think we have seen already yields on government bonds or interest rates already come down. So it's fine if, if interest rates, because of the fiscal deviation, temporary deviation, if interest rates go back by about another 25 to 50 basis points, I think that's fine. That would just be a temporary knee-jerk reaction. But I think the positive benefits of kickstarting public investment and accelerating private investment, I think would more than compensate for a temporary deviation from the fiscal deficit path.
Rating agencies, international investors, will they react in a similar manner?
There could be temporary knee-jerk reaction, but I think when you basically explain the narrative and saying that we need to really kind of get growth back and start growing at 8% plus on a sustainable basis, I think they should see reason. Even if you really look at it, despite the fact that this government having wonderfully and commendably having stuck to the path of fiscal consolidation and fiscal discipline, somehow the rating agencies have yet to respond in a significant rating upgrade so far. I mean, we are still in the company of countries like Spain and all of them in terms of our ratings, which anyway I think is absurd. So I think for the time being, one should not pay too much attention to really what the rating agencies are going to say or respond. And I think if the measures which get unveiled in the budget clearly demonstrate that this will lift growth and create a sustainable growth cycle, I think they should be fine with it.
Right. In terms of what happens with the taxes, as you said that the direction was already expected to be on the negative, on the declining side. But with demonetization, can tax cuts be slightly higher or earlier than what was earlier anticipated?
Yeah, I think it's going to be fine if these tax cuts happen. I think clearly a 2 to 3% reduction in the corporate tax rate, I think, is something which should not honestly be a challenge. Clearly, I think in India, indirect taxes, of course, are a very significant pie. And I think once GST comes in, that pie is only going to get larger and more than compensate for a small reduction of 2 to 3% in the corporate tax rate, number one. Number two, I'm quite sure some of the exemptions which are there for corporate taxes, I think will also kind of get withdrawn or be taken away. So there will be some kind of nullifying which will happen within the corporate tax basket, as well as some amount of nullification which would happen because of GST. So I clearly believe that I think if the government does intend to go ahead with tax rate cuts for corporates, they should go away with it. I think that will be a very important and a significant incentive for private investment to kickstart. We have to keep in mind that private investment cycle is virtually at a decade low. And that's something which needs to kind of come back very, very strongly. And it's quite possible that reducing corporate tax rates can be a very important stimulant and a fillip to kickstarting the private investment cycle.
In terms of what's happening globally, noises are coming out that in US also you may see big tax rate cut. So, just to compete with that also, the direction should be on the downside?
Well, I think at this rate, US is definitely not a competition. I don't think, when companies invest in India, it's not yet US versus India. It's still about India versus China versus some of the other emerging markets like Brazil, Russia, some of our neighbors in Southeast Asia, and some of our immediate neighbors in South Asia as well. So clearly, our tax rates should essentially be made attractive relative to the tax rates prevailing in emerging markets or some of the other fast-growing economies. So yes, if the US goes ahead with reducing corporate tax rates, I think it will be a very, very important signal to rest of the world to kind of go ahead and cut their tax rates as well. But I think for India still the competition is going to be the corporate tax structure in some of the other large and mid-sized fast-growing emerging market economies.
Let's talk about personal tax as well, and how important will it be for the market? Talks that exemption limits may move quite significantly from where they have been. Is that important for consumption to pick up?
Yes, we clearly believe that I think reducing tax rates at the individual level will honestly be very positive. It will increase disposable incomes, which will find its way into the consumption mainstream of the Indian economy. So clearly, I think apart from reducing corporate tax rates, I think it would be very good if there is a cut in individual tax rates or there is hike in exemption limits for individuals. And I think that will be very, very positive. That coupled with some of the benefits that you get for taking home loans and all of that, I think if on a very comprehensive basis will be extremely positive for individuals, Indian households, and for the consumption related growth that India has been witnessing over the last many years.
If we look at interest rates, they are of course at a low, just about 8.1% in terms of prime lending rate for some of the top banks. Can interest rate alone be a factor because of which the economy goes up, or government will have to give a stimulus in this budget for both of them to work together?
Well, that brings back to the classical school of economics that does interest rate drive growth, or growth drive interest rates, or does growth fuel inflation, which in turn essentially leads to interest rates. I think what we have seen really over the course of last 1 or 2 years is that interest rates have come down. But that's not necessarily taken growth to a higher level. It has definitely provided some kind of a floor. So despite the kind of global headwinds that the Indian economy is experiencing, we're still growing at about 7%. So to that extent, I think interest rates, if they have not been able to fuel growth, they have been essentially supportive of growth. But interest rates in isolation may not be good enough. Especially if we have to aspire for a higher growth rate of 8 to 9%, then apart from low interest rates or stable interest rates, we need a lot of other measures, including fiscal measures, fiscal incentives, and some of the other policy initiatives, which really can help and bring back growth, kickstart the investment cycle, so that we can kind of get to an 8 to 9% sustainable growth, and in the process lead to a lot of job creation. So I think it's not just interest rates alone which will be sufficient. There would have to be many other measures which can really bring growth back into the high single-digit range.
Earlier there were some talks that there will be some changes in the long-term capital gain structure and the stock-term capital gain structure for capital markets particularly. Will that be a big event to watch out for?
It's definitely an event which the market, the street, and everyone is really looking out for. But I'm not quite sure. I mean, clearly we heard the finance minister come in and clarify that there would not be any taxes, or there is no intention to levy any taxes on long-term capital gains on equities. And I think if that continues and if there is a status quo, I think that's going to be a huge relief to the market, because the reality is that I think it would be important to plug some of the loopholes or any of the kind of misuses which happens with long-term capital gains, and for participants who basically misuse the exemptions which long-term capital gains are there. So I think it would be far more important to plug those loopholes rather than just tweak the tax structure. So if that tax structure is tweaked, I think in a way there would be a negative reaction to that. But if that structure is not tweaked and if there is a status quo, I think that will come as a huge relief to market participants. I would essentially take back to a similar situation last year, that in January our markets fell, and in February our markets fell even further as there were apprehensions about the government imposing tax on long-term capital gains, and because of which we fell a lot more in February. So I think it would be best if that structure is left unchanged. But if there was to be any change in that, I think there would be some kind of an impact.
Say if a little bit of increase in the short-term STT or any marginal changes happen in terms of rates, will the markets take it in a matured manner?
I think tinkering with the STT I think should be fine, because that's something which you incur on transaction. But I think hiking it beyond a point could impact liquidity. There are a lot of volumes which really happen in the marketplace because of intraday trading of arbitrage and those kind of strategies. So a bit minor tweaking of STT I think should be fine. But I think if the STT is hiked significantly, then that will impact volumes and will also impact liquidity in equity markets.
Right. As far as overall tax structure of capital gains is concerned, markets know that if the long-term capital gain tax happened, STT would go away. That's the noise that you're getting. If that happens, again, it will become like what it was. So not a major impact.
Yes, I think there would be those trade-offs, but somewhere I belong to that school of thought that you should basically leave the exemption on long-term capital gains untouched and continue with the STT regime, because I think the STT collection, the imposition of STT, collection of STT is a very smooth, seamless and a transparent affair versus trying to collect taxes on long-term capital gains. I think the basic fundamental logic is that in the case of STT, it just levies when you transact. In the case of tax on long-term capital gains, basically that tax gets collected in a back-ended manner, if at all there is a long-term capital gain. So I think from a government's point of view, I think the STT is a far more efficient way of collecting taxes versus imposing a tax on long-term capital gains.
Right. In terms of FII, the taxation structure, do you expect clarity to come into this budget? How things will happen after 1st April? There has been a lot of, slight bit of confusion with the releases that the government has given so far.
Oh yes, I think there has been a lot of confusion and all of that, and I think it's good that the CBDT and the Finance Ministry has come in and made timely interventions and have made clarifications. But I think it would be good if the budget again is used as some kind of a platform to further clear the air on these matters relating to taxation for various market participants.
Right. Say if the GST were to come as per the target timeline, no changes into indirect tax, that's what you would expect into this budget?
Well, it's quite possible that, I think what has really been stated is that the new timeline for GST is 1st July.
Right.
So that's not too far away. It's probably just a few months away. So I think it's fine even if the budget does not get into the realm of, the GST or the tax rates. I think that's fine. I think that as an independent exercise is well underway. And I think this government has been doing a commendable job in moving towards implementing GST. But I don't think there was any downside to basically already changing the indirect tax rates to bring them in line with the intended tax structure in GST. So probably I would be indifferent on this matter or on this score, that even if they wait for GST to kind of get implemented and don't tweak with the indirect taxes, I think that's fine. But even if they were to kind of go ahead and tweak the indirect tax rates right now to align with the future GST rate, I think that also is fine. So I think probably one is really independent what the government does on this matter.
Let's talk about some sectors that will be in focus. Say if the stimulus has to be given, will it be low-cost housing, auto? Where do you expect changes to come in?
Well, I think, Pankaj, you really hit it bang there, in the sense that I think housing and auto are two very big sectors where there could be scope for a lot of fiscal incentives. Both these sectors have a multiplier effect on the economy in terms of job creation, in consumption of cement, steel, and therefore benefiting the core sectors. So to that extent, I think it would be pretty much orderly for the government to go ahead and announce some incentives, especially for housing and automobiles. These are two very, very big sectors. In addition to that, I think agriculture, especially on irrigation, I think should be a very, very big thrust area. and any measures which finally lead to increase in the income for rural households and for increasing farm incomes, I think that would be in line with the government's long-term strategy of doubling farm incomes. So any kind of benefits, measures, incentives which help the farmer to realize more, to produce more, improve the yields and increase his income, I think will be welcome. So on the whole, this budget would have to offer many such initiatives which lead to kickstarting both India and Bharat, both urban India as well as rural India.
Right, and some of these sectors that you just mentioned about, they are very interest rate sensitive as well. So with interest rates being low or where they are, if there is a little bit of more benefit given, the recovery could be much faster?
Yes, clearly I think because both these sectors are essentially, if you really look at it, demand is significantly now driven by the EMI culture. And I think it's becoming more as what is the monthly installment you are paying to buy a new home or to buy a new automobile. So clearly that interest rates do definitely play a role. But we have to keep in mind that interest rates have come down. Both these spaces are reasonably competitive. In a way, there is a race between the banks and the HFCs and the NBFCs to lend at the least possible interest rates. So I think everybody is offering lower interest rates. So clearly going forward from here, I think there's very limited room for interest rates to come down, and therefore it will have to be basically fiscal incentives which will essentially end up being a bigger and a quicker sop for the Indian consumer to buy more homes or buy more cars or two-wheelers rather than just lower interest rates.
As far as the speech of Mr. Modi is concerned on 31st of December, can one take a direction from that speech as to this will be the focus going into the budget or just after that?
Oh, absolutely. I think there's no doubt about it. Clearly, if one takes a cue from that, the focus would be of this budget would be on the segment which is at the bottom of the pyramid. The focus would be on the middle class. The focus would be on rural India. There's clearly going to be focus on sectors like housing and some of the other allied sectors, rural sectors like irrigation. So clearly this is really the focus is going to be here. In addition to that, if the focus is also on corporate India, such that there are measures unveiled to basically kickstart private investment, I think then it would end up being a very transformative budget, a very comprehensive budget, and a budget which is truly extraordinary to really kind of get growth back to the 8-9%, which is truly India's long-term potential.
Let's talk about infrastructure as well. A lot has happened in the last 7-8 years. A lot of balance sheets, a lot of big corporates have tried to repair their balance sheet, try and focus on investment. But somehow the risk appetite in the market for investment seems to be very low from the private players. How do you think government will get that confidence back? Will they spend more or they give some incentives to private players to invest?
Well, the government has already increased the public investment, and I think that's a fantastic start. I think what the government so far over the last 2.5 years has done is to clear a lot of policy hurdles, a lot of policy logjam. So I think that's been a commendable feat. The second thing which the government has done is to increase public investments. And I think it's very imperative that even over the next 2.5 years, the focus should be on further upping public investment. So as we've seen policy hurdles getting cleared, as the public investments have been upped, you would essentially in the initial phase see the private sector come in and join hands with the government and implement a lot of projects. Though as contractors or as engineering consultants or as EPC players, the private sector has already kind of come in and taken the lead. I think it will still take some time for the private sector to kind of go ahead and start implementing projects independently, but I don't think that is too far away. What can hasten and expedite this process is for the government to go ahead and announce some of the fiscal incentives which really makes the private sector come out of its shell and go ahead and say that I want to now start implementing projects independently because it really makes a lot of sense for us to do so. So I think clearly the government has done a lot, but I still think a lot more needs to be done, especially in terms of fiscal incentives.
But you expect public spending to increase and the quality of spending to be good?
I think so, and I come back to the initial point which I was making, is that it's fine if the government kind of goes ahead and deviates a bit from the fiscal deficit. The only way to kind of, increase the public investment is to kind of deviate a little bit from the fiscal deficit target. I think deviating from it for the next 1 or 2 years, I think should be fine, if the deviation is not too much. And I think the moment the government is willing to kind of even deviate a little bit away for a year or two from the fiscal deficit, that will release a lot of funds for public investment. And then I think you will actually see public investment going up significantly, which bodes really well for some of the core sectors, which finally will lead to basically better growth rates for the economy on an overall basis.
Right. In terms of infra, we've been speaking to a lot of infrastructure, steel companies. Do you think that more benefits would come towards mid-sized companies or smaller scale, because that's where the impact has been very high?
I'm not quite sure if those kind of fiscal incentives would just essentially depend on size, because I think in some of the core sectors, there is virtue in size, which means that there is virtue in being a large size player, especially for, sectors like steel, cement. There is merit in basically having a larger capacity, which drives in economies of scale, which in turn means lower prices and therefore final benefit for anybody who's putting up a project or anybody who's the end consumer. So I'm not quite sure whether any of these fiscal incentives would just be directed towards the smaller business units or the smaller sized cement or steel units. I think it would be good if basically that differentiation is really not there between small and big. Yes, if there are those independent enterprises, especially in the services sector, like tourism, hospitality, and those kind of players, maybe that's where you would actually see a lot of the small sized units coming up, and maybe there it might be orderly to give fiscal benefits for only the small sized units. But I think when it comes to really some well established core sectors, I don't think fiscal incentives or benefits should just be based on size.
Just a word on the digital push as well. A little bit of announcements have come in, but you expect that to get more people focused on banking and digital transaction, some SOPs may be given?
Yeah, I think that's a very interesting debate, because there are two schools of thought, that you incentivize spending through the digital mode, or you disincentivize spending through the cash mode. And I think that's essentially the key argument which is going down, which means that do you in a way penalize somebody by spending in cash, or do you incentivize somebody by spending through the digital mode? And I think it would be very important to kind of, for the government to keep incentivizing spending through the digital mode, because I think there's a longer track of that spending, and I think that data is going to be very useful. And in a way, I think, it's important to, in a way, entirely digitize the Indian economy and the spending which happens there. So I think, yes, the government should continue to basically provide the incentives which it has been, and perhaps even further provide more incentives to basically take out that inertia from Indian households and give up the age-old habit of spending in cash and start spending through card or through other digital means.
Right. Nilesh, just one last word on two sectors that are always in focus going into budget. So one is tobacco and the other is PSU Bank. What do you expect in terms of PSU Bank recap, and do you expect any major changes to tobacco excise as well?
I think in terms of the recap, I doubt if there would be any significant change from the government stated policy. Just to keep in mind that the government had unveiled, I think 2.5 years back, an entire comprehensive strategy for PSU banks. And our sense is that that's something which will continue. These banks are flush with liquidity. I don't think there is an immediate constraint of capital. Of course, there is a long roadmap to get to the Basel norms of capital adequacy, and that will also have to be kept in mind. But I'm not quite sure if a significant recap of PSU banks would be really on the top agenda of the government. I think really on some of the other areas as well, I wouldn't be surprised if the government adheres to a path of status quo. So I clearly believe that this budget is where the government uses some of the fiscal space to go ahead with some of the fiscal benefits, incentives, tax exemptions, lowering interest rates, or lowering tax rates in a comprehensive manner to really kickstart both the private investment cycle as well as consumption by Indian households. I think this would be the two big priorities of this budget.
Nilesh, thank you so much for taking out time for us. Always a pleasure talking to you. And once the budget is given out, after that, hope to get your views for our viewers.
Thank you, Pankaj. Thank you. It's always a pleasure to be with you and to be with your channel.